So there we were. Everything was set up perfectly for mortgage rates to go down. And then we had a Grinch that stole our Christmas. This is the weekly report on Major Money Matters. Welcome to Major Money Matters. My name is Major. I'm the host of Major Money Matters. I'm a mortgage broker powered by Edge Home Finance. And this is the weekly report where we talk about what's going on economically and how it could be affecting your home buying or your home selling process. And let's get right into it. We start with the charts as we do every single week. You know, as this line trends up, you're seeing mortgage rates go down. And as this line trends down, you're seeing mortgage rates go up. This week, we had couple of things happen in the market that actually shifted the market, where interest rates are actually a little bit higher than they were on last week. Now, generally, we're still in a standard trend line where we're seeing interest rates in the low sixes on a 30-year fixed conventional with 20% down. VA loans, you're seeing interest rates in the high fives to low sixes, depending on your credit situation. But we're doing okay. But we were expecting things to go a lot lower this week. We did not get that. And I'm going to tell you why. And it's because of the two Grinches that came in and stole our Christmas gift, which was going to be lower mortgage rates. The first thing that had an impact on interest rates this week was Japan. Japan actually increased their yield on their 10-year bond from 0.25 to 0.5. So Japan was doing a bit of quantitative easing where they were suppressing mortgage rates to stimulate their economy. And they said they were going to allow the 10-year treasury yield to go from 0.25 up to 0.5. And what you see there is you see people who had bonds or money in our 10-year bond or would normally invest money in the US 10-year bond started to shift money over to Japan for higher yields. So that had an impact. And when you have that done, people sell their bonds, and you know, selling off of bonds causes our chart or our trend line on mortgage-backed securities to go lower, which means higher interest rates. Now, fortunately, this was seen as a one-off and not something that Japan is going to continue to do over the course of time. The bond market recovered from there, but it did cause a level drop of a little bit to increase interest rates very, very slightly on this week. The second thing that impacted interest rates this week was a spending bill that Congress is actually in the process of passing. Now, this is a bipartisan bill, so it is very likely that this is going to pass to the House and the Senate. But this is having an impact on mortgage rates, and I'll tell you why in a second. First, I want to cover what's in the bill. First, let's cover what's in the bill. What's in the bill is relief for Ukraine, restrictions on TikTok, relief funding for the U.S., defense spending, funding for election security. Now, again, this is a bipartisan bill, so I'm not here for your politics. It's a bipartisan bill. I'm only talking about how it's affecting mortgage rates in the bond market. So how do we get the money to pay for this? It's a $1.7 trillion bill. The reason that the way that the government is going to raise this money is going to be by selling mortgage bonds. So that's going to affect the price of mortgage-backed securities. Increased supply to anything when demand is stable is going to decrease the value of that thing. So mortgage-backed securities are going to sell more. So right now we have this fight between the great PCE numbers that came in, the personal consumption expenditure report, and the increased supply that we're going to have to bonds. And those things are fighting right now. And it's to be determined to see which one wins. Right now, we just have a lot of lateral movement in the market on the chart. So that's the other thing. That's really, if those two things would not have happened, Japan increasing their yield rate and the spending bill, we would have lower interest rates right now. That's why when we talk about mortgage rates, we say all things remaining equal, because there are multiple things outside of just, there's so many things that are playing into the market and the interconnectivity between countries that sometimes you cannot predict what's going to happen in the market. So we just say all things remaining equal, because you have to view things as a totality. The next thing we want to cover is this story. Home sales tumbled more than 7% in November. Now, keep in mind that this is home sales. So you'll have people who say stuff like, well, home sales are going down. That's not the value of homes necessarily. This is the amount of sales or the number of sales. So home sales tumbled for the 10th straight month. It declined. Let's talk about why homes are not selling. Number one, 2/3 of all people with a mortgage have an interest rate below 4%. So if you sell that home, then you're going to go buy a home, and the prevailing interest rates now are around 6%. So nobody wants to give up a 2, 3, 4% interest rate and go buy a home at 6%. So you have less listings on the market. The other thing is higher interest rates. Yes, the 2-1 buy down is helping a lot of people. In fact, the existing homes report came out this week. 28% of buyers or 28% of homes are being bought by first-time home buyers. Only 1 in every 7 homes right now are being bought by investors. So numbers are looking good for first-time home buyers to take advantage of this, because you have a lot of motivated buyers, especially right now during the holidays. Nobody's selling their house right now unless they actually want to sell their house. They'd wait till after the holidays. So right now is actually a good time for, if you're a first-time home buyer, to get into a home. Also, this story, housing market supply is keeping prices from crashing. Now, let's compare that with the homes report that came out this week and the numbers on residential construction for the month of November. So permits were down 11% month over month and 22% year over year. So less builders are actually starting homes or starting the permit process to begin homes. So housing starts are actually down. The reason this market is different from the 2008 market is because there is simply a lack of supply, and builders are not overbuilding. Even builders that are building right now are given a lot of incentives to sell the homes that they contracted to buy 6, 7, 8 months ago. So you have situations right now where builders are not building more homes, and the fact that there is simply not enough supply is actually maintaining the prices of homes. The housing market is a lot about supply and demand. In 2008, there was an excess supply of homes. Right now, builders are saying, well, we see where the interest rates are. We see there's not enough interest in buying, so we're building less homes. And that lessening of the supply is actually maintaining prices where they are, which is why you're not seeing or likely going to see a housing crash due to this market, due to higher interest rates. So what's my final takeaways from what we're seeing right now? Okay, we're gonna have to be patient. We're gonna have to let the market settle out. There is less trading going on right now, especially in the bond market, and international and governmental factors are actually affecting interest rates and keeping them from moving lower at a faster pace. However, you are seeing some lenders who are being more aggressive in their pricing. So right now, even my company brought on 2 more lenders who have very aggressive government pricing. So there's lenders who are taking more risk because they believe in the stability of the market and they believe in the stability of the buyer. So they're offering lower interest rates and stuff like that. That's why you need to be working with the broker. Access to many different lenders that can see the market and see what's going on with many different lenders. But we'll talk about that more on next week. But for now, we want to say Merry Christmas to you all, and we hope you all have a Happy New Year. To all of our clients who we support and our clients who trust us, all of our real estate partners, we absolutely adore you, and we thank you for all of your support, and all of our wholesale lenders, our AEs, the underwriters that we work with to help with families in their home. We thank you for everything that you do to support us. Have a very Merry Christmas, and we'll see you next time on Major Money Matters.